Alright, hello traders, Jeff with optionboxer.com, bringing you another strategy video, or it's more or less, it's just a continuation on the income strategy video I placed or put on my website or on YouTube about a week ago. And it's the only difference is it's going to be the exact same strategy, just going to be done on Robinhood rather than Thinkorswim for probably the thousands or millions of traders that use Robinhood. I was talking to a friend of mine and he had questioned me about using Robinhood because the video more or less uses just Thinkorswim. So before we get into it, I'll pull up my timer here. I'd like to have this video done in 10 minutes or less. But before I begin, you should know I'm not a financial advisor, and this is not a recommendation for you to buy or sell any security or to implement any strategy that you see in this video. You should know that I am wrong probably more than I'm right, and you should always do your own research prior to placing any trades. Options, forex, futures, stocks, you name it, it all has risk, and the risk of loss is very real. So make sure you understand that before you place any trades. Okay, so with that being said, I want to give you a brief lesson on options so that you can understand kind of what it is that we're doing when we sell a put or sell a call. All right, sorry about that, I had to get something to drink. All right, there's 4 principles you need to understand about options prior to trading options for sure. Or if you're just learning this, these 4 principles will help you out. 1, if you buy a call option, you have the right to buy shares at this strike price. If you were long, is what they say, if you're long a call option, you want the share price, as you can see here at 472, you want share price to move higher. You are bullish on the stock. If you are long a call, you are bullish, and you have the right to buy shares at the strike price. On the other side, if you are short a call, you are bearish on the stock. You want the stock price to decline. Okay, that obligates you to buy shares. So if you're long a call, you have the right to buy, and if you have the right to buy, somebody's got to sell you those shares at this strike price. So the other side of your long call would be your short call, and now this person, whoever this is, would be obligated to sell you those shares at $5. So if you're long a call, you have the right to buy. If you're short a call, you're obligated to sell at the strike price. Okay, puts work much the same way. If you were to buy a put option at the $5 strike here, you now have the right to sell. Again, you have the right to sell, but not the obligation. You have the right to sell shares at $5. On the other side of that, I should say that also if you buy a put or if you're long a put, you are bearish on the stock. You want the stock price to decline. If you are short a put and you sold this $5 put, hypothetically, you are now bullish on the stock and you want the share price to increase. But because the person that bought the put has the right to sell shares, you are now obligated to buy shares at this strike price. An option is nothing more than a contract between 2 people, and when it's placed, it's a binding contract that will be exercised automatically by the broker, or maybe by the CBOE exchange. I'm not sure who actually does the deal, probably the broker. Regardless, it's a binding contract, and so you need to understand those 4 principles, and I'll recap them here just briefly. If you are long a call or if you buy a call, you have the right to buy shares at this strike price or at whatever strike price you decide to open a contract on. If you sell a call, you have the obligation to sell shares at that strike price. If you buy a put, you have the right to sell, and if you sell a put, you have the obligation to buy. So long call, right to buy; short call, obligation to sell; long put, right to sell; short put, obligation to buy. So understand those 4 principles and options trading becomes infinitely easier. And I'll be honest with you, it took me a while to really grasp that concept and to see how it see how it all works in the context of all these different strike prices and contract months and so forth. But once you understand those 4 principles, the rest of it becomes easier, and you can start structuring more advanced trades and all that good stuff that options offer. Which, as it is, you can find a wealth of knowledge on my website, optionboxer.com, and I hope you'll check it out. But regardless, let's go ahead and look at the strategy. I got about 4.5 minutes left to get this done. So hypothetically, we wanted to set up a trade. Let's say that I had the money in my account and I could cover the collateral needed to sell this put short. Let's say I wanted to sell the $5 put. So I'd come in, I'd put one, I'd maybe want to get a little more money for my, collect a little more premium, so I could probably set this at 34, maybe 35, and I may have to wait a little bit throughout the day, but I still may get filled and I could take $1 or $2 more. Or if you're in a hurry, you just wanted to get filled, I'd set it at the mid price. And generally speaking, once the market opens, whatever the mid price is, you're probably going to be filled fairly quickly. You should also know that you should only employ this strategy on liquid assets. And what I mean by liquid assets is you can come up here. If you're in Robinhood, you can come to this little symbol right here, and you can see that the open interest is 2,846 and the volume is 353. So basically, real quick, what this is it's telling you today the volume, there was 353 contracts at this strike price of $5 traded. This open interest number indicates the number of contracts that are open at this strike price. So there's potentially 2,846 contracts out there that are open, that weren't open today necessarily. Some of them were, and some of them may have been closed, but there are still 2,846 contracts floating around out there to all the different traders that are trading Chesapeake Energy. Today there was 353. That's more than enough volume. Another quick way to kind of identify whether shares are liquid, whether options are liquid or not, is this limit price, or this bid-ask spread, if you will. It's a little easier to see here on Thinkorswim. You can see the bid-ask spread. Here's the bid, here's the ask. You can see it's about 2 cents wide all the way across. It gets a little wider there, but for the most part, it's about 2 cents. Let's see, I think maybe FAS is a little less liquid. Yeah, so you can see here, there's still quite a bit of open interest, but volume was kind of low there. And you can see the bid-ask spread is pretty wide. So that's a quick way you can tell whether or not something is liquid. And the idea is you want it to be liquid so that you can get in and out of your position. So that's just another little side note for you. But anyhow, this is where it's going to get good. I got just a couple of minutes left. I'll pull that timer back up. Got just a couple of minutes left here to get through it, but this is the best part. You're gonna really like this, I believe. So let's say we didn't own any shares and we had the money. We're ready to place this trade. We could sell this put. Since we sold a put, we are bullish on the stock. So if we were at this $5 strike, we would want the share price to close on, let's see, our expiration month is the 22nd of June. So by Friday, we would want share price to be above $5. At that time, if it was above $5, we would take this 33 cents. It would be deposited in our account, which it will be deposited in your account the minute you sell this put. But then there's no longer any risk. If share price closed at, let's say, 505 on the last tick of the day, you would take this 33 cent credit and you wouldn't own any shares. You would just be given the 33 cents because you fulfilled your end of the contract, and this thing stayed out of the money. And you get to keep the premium. Now let's say that you sold this $5 put and share price finished right here at 472. Well, now you're going to be assigned the shares. And the beauty of Robinhood is you don't pay commissions, so you're not going to pay a $20 fee, which is what I would pay on Thinkorswim or through TD Ameritrade if I was assigned the shares. And you can see down here that I showed you earlier, I was assigned on a $5 put. I collected 17 cents. But I had to buy the shares for $5. So right now I'm showing a $28 loss, but that's a little bit misconstrued because it's basing that number off my average cost and what the current share price is, which means I'm at 28, but it's not taking into consideration that I received the 17 cents in credit when I opened the put. So I'm actually only down by about $11, but this is the real fun part. So now once I own the shares, I can come in here. Oh, sorry, I don't want to sell short. I want to go to options. You can go to whatever expiration cycle you want. Just about out of time. You can go to whatever expiration cycle you want. I'm going to trade it right here at the nearest term expiration, and I can sell a call at the same strike price. I could sell it at any strike price. If I wanted to collect a little more premium, I could come down here, but I could sell this $5 call. Now I'm only going to make $6 on the call, but regardless, I bought the shares for $5, and now I'm going to turn around and I'm going to obligate myself to sell the shares at $5. So I basically bought them for $5, sold them for $5, but as it were, I collected the 17 cents to begin with, and now I'm going to collect another 6 cents. So I basically just took 23 cents or $23 out of the market, and there was no risk. Now you can see, if this were Thinkorswim, I would have been assigned the shares. I would have had to pay a $20 commission, and then if I was exercised on this call, which at the moment I would not be, but if I was exercised on this call, I'd have to pay another $20. So there would be $40 right there. You could see how commissions would eat up any profit potential in a trade like this for a smaller trader like myself and like so many others. But Robinhood makes it possible for this to be a reality. And so you would just come in here, do the same thing you did for the put, just put 1. You may be able to get 7 cents, maybe a little bit more, and you would set the trade up, and then on the 22nd, if it was in the money, you would automatically be exercised. You would automatically be exercised or assigned, and the shares would be called away from you at the strike price of $5, but you would have gotten to keep the 6 cents that you received here, and in my case, the 17 cents that I received on the put side. Hopefully that made sense. If you have any questions, reach me at optionboxer.com. Thank you for watching. Bye-bye.